Retail bankruptcies are up by 61%, new data shows. In addition, U.S. store closures have shot up 77% over the past year, and a fresh report released by Retail Dive in partnership with credit reporting agency CreditRiskMonitor identifies several retailers that are most at risk of facing bankruptcy in the final months of 2023 or have just filed for Chapter 11 protection and are about to close doors for good. Americans will be shocked to see dark storefronts and shortages of hundreds of products during the holidays as more and more brands shutter locations and halt operations in many areas of the country. This trend will only intensify over the next couple of months, changing our retail landscape forever. That's what we're about to expose in this video. So stay tuned until the end to find out if your favorite store is about to go out of business in 2023. 1. Petco. Pet supply store chain Petco saw a boom during the pandemic when consumer demand soared. Back then, the pet retailer recorded a spike in annual sales, and its shares almost doubled in price. However, as the economy reopened, Americans started spending their money on other goods and services, and the brand faced some hefty losses. Petco was seen as a highly leveraged investment, according to financial analysts. But without resilient sales growth and amid slowing foot traffic, investors began to realize that its stock wasn't worth holding anymore. And in August, shares plummeted by 24% in a single week. Overall, its market capitalization has declined by 65% over the last 12 months. The retailer is also dealing with a huge debt load, currently at $3.03 billion. Unable to improve cash flow and profitability, Petco is on a bankruptcy watch list right now, according to Retail Dive. The company is at serious risk of debt default, with an almost $800 million loan payment coming in this quarter. If it fails to meet its debt obligations, shareholders are likely to pressure the brand to come up with a debt restructuring plan and a Chapter 11 bankruptcy filing. 2. The Container Store. The Container Store has seen some ups and downs in the past few years. Right after the pandemic broke out in the U.S., sales dropped by nearly 28%. But by December 2020, when stimulus money started entering the system and consumers were eager to spend their dollars, the company saw a 20.5% sales growth, which rose to 30.4% in early 2021. Unfortunately for the home goods retailer, gone are the days of shoppers spending freely on home supplies, remodeling, and organizing their spaces. Net sales in the first quarter of 2023 plunged by 21%, which CEO Satish Malhotra blamed on the challenging macro environment. Then, the retailer announced mass layoffs to cut on costs and restore its balance sheet. Malhotra even accepted a 10% pay cut to help pay for employee raises and severance fees. On top of all that, the company's stock crashed by 56% over the past year. That's why CreditRiskMonitor sees a high risk for the company to go bankrupt in 2023. 3. Big Lots. Big Lots is seriously struggling this year. The discount retailer reported poor sales performance for several quarters in a row, with the past 2 quarters seeing double-digit sales declines. According to the latest data available, the company's sales fell an additional 15% in August, which exacerbated its liquidity issues and prompted executives to introduce new cost-cutting initiatives. CEO Bruce Thorne says that inflation is hitting low-income consumers particularly hard, and they are the brand's main customer base. However, Big Lots' problems are hardly new. Their revenue, profit before tax, retained profit, total assets, and net worth have all declined in recent years, as revealed by Matthew Dabbage, CEO of the Americas and Asia at CreditSafe. At the same time, their liabilities have increased substantially, a terrible combination that is pushing the company an edge closer to bankruptcy, CreditRiskMonitor analysts say. Having lost 71% of its market capitalization since October 2023, the retailer is in dire financial condition and it may go out of business before year's end. 4. Noble House. Some people may not have heard this name before, but they are definitely familiar with Noble House's products. The company is a distributor, manufacturer, and retailer of indoor and outdoor home furnishings with distribution throughout e-commerce channels, including partners such as Amazon, Walmart, Costco, Wayfair, Overstock, Target, and Home Depot. It also sells through wholesale channels, primarily to TJ Maxx, Home Goods, Marshalls, and Ross stores. Noble House was founded in 1992, and the family-owned retailer designs, markets, and sells products under several brands, including Christopher Knight Home, Noble House itself, Le Pouf, Okioki, Best Selling, and GDS Study. In recent months, the home furnishing sector has been experiencing a major slowdown as more Americans delay home purchases and renovations due to soaring costs. This was one of the reasons why Noble House decided to file for bankruptcy this month. Coping with serious cash flow problems and owing millions of dollars to vendors in China and Vietnam, the brand decided to file for Chapter 11 to try to renegotiate its debt. While its future remains uncertain, for American consumers who shop for home furnishings at major retail chains, this means higher prices and product availability are about to hit thousands of stores this winter. 5. Kirklands. Home decor and furniture retailer Kirklands may not survive the recession, retail experts say. The durable goods sector typically sees huge drops in consumption and manufacturing during economic downturns, which could send the struggling company over the edge in the next couple of months. The chain operates 360 stores across the U.S., but sales performance is currently disappointing at most of its locations. The company's total revenue dropped by nearly $100 million since 2022. Meanwhile, gross profit margins dropped from 32.81% to 2.31% right now. To make things worse, Kirklands has very little cash on hand. Over the past few quarters, cash levels declined from $80.16 million to just $25 million. In the first half of 2023, the brand has blown through cash in preparation for a strong holiday shopping season that may not materialize this year. The company usually relies on the holiday season and end-of-the-year sales to bolster the next year's cash flow. However, this year's drop in cash is still substantial and leaves the company with little protection and flexibility during times of uncertainty, as noted by Seeking Alpha analysts who applied a sell rating to the retailer's stock. Given that Kirkland has $35 million in debt, it will have to issue more debt at more expensive rates to stay afloat in the next couple of months. But that's only if banks, which are tightening their lending standards, agree to borrow more money from an indebted company. Unfortunately, that seems unlikely, considering the potential for further losses and the high risk of debt default. No wonder why the retailer, Kirklands, is also on the bankruptcy watch list for the fourth quarter. 6. Vince. The casual luxury apparel brand is being hammered by the competition in 2023. Vince is currently trying to negotiate a sale that has a huge potential for failing due to its precarious financial situation and the rise of similar brands in the market. Having lost more than $250 million since 2016, Vince seems to be fading away in the U.S. retail landscape. The company's latest earnings report shows that sales dropped by 21.9% over the past year, and 11.3% since the previous quarter. And while this year's losses climbed to roughly $91 million, net income is at just $1.8 million, meaning that the brand is in danger of becoming insolvent. Even CEO Jack Showfields bluntly admitted that he has substantial doubt about the retailer's ability to stay in business for the next 12 months. With upper-income Americans tightening their belts to prepare for turbulent times ahead, it doesn't look like things will improve for Vince anytime soon. 7. Rent the Runway. Apparel retailer Rent the Runway became a hit in recent years for renting high-fashion items for everyday women who wanted to stay up to date with constantly evolving trends without breaking the bank or repeating their outfits. With over 800 brand partnerships, sizes ranging from 00 to 22, and 3 main subscription plans, the business became a huge success, reaching more than 11 million subscribers at its peak. But things have taken a drastic turn for the worse in recent years. In 2020, its active subscriber count fell by almost 60%, and the company reported a loss of $171 million that year. Since then, conditions haven't improved for the retailer. In fact, Rent the Runway just announced a restructuring plan, including cutting 24% of corporate employees. Meanwhile, the subscriber count fell to 124,000 active members, and its stock crashed by 90%. For those reasons, CreditRiskMonitor analysts believe the company will not make it into 2024. 8. Kohls. Iconic department store Kohls insists that the middle-class squeeze is the main reason why its retail business is falling apart. But analysts suggest that the chain's problems are of its own making. After reporting a 6.6% drop in sales and $302 million in losses, global data analyst Neil Saunders says that Kohls' poor performance mostly reflects its abysmal lack of standards and operational control. Another analyst warned that Kohls is overly dependent on its partnerships with other retailers. It has long relied on other retailers such as Amazon and Sephora brand equity to drive traffic and sales, which isn't a path to sustainable growth. Zach Stambo, senior analyst at Insider Intelligence, wrote in a recent note. The company has been facing a challenging few years, marked by lagging sales and an onslaught of attacks from investors who've been criticizing the company's performance and leadership. Right now, Kohls is dealing with a new top executive, a challenging economic forecast, and a 71% chance of facing bankruptcy, Stamper added, saying that righting Kohls' ship won't be easy. 9. 99 cents only. Discount retailer 99 cents only store saw wider losses in its latest quarter as sales and margins continued to slide. The company reported sales of about $480 million for the quarter. That's a 3.8% drop year over year. The business also reported a loss of $27 million, while its gross margins fell by 5%. The disappointing results led Moody's to drop the corporate credit rating of the regional discount, indicating a deepening default risk and higher potential for bankruptcy. The downgrade reflects the company's much weaker than expected operating performance, which has constrained liquidity as we expect free cash flow to remain negative, Moody's Vice President Mickey Chatter said in a statement. On top of that, the discount is losing ground for competitors such as Dollar General and Dollar Tree. Moreover, discount grocers such as Aldi are taking up more market share, and many 99 cents only stores look less attractive for both investors and consumers. 10. Farfetch. Luxury goods retailer Farfetch lost more than 40% of its market capitalization so far this year, as demand in the company's two top markets, the United States and China, sharply dropped due to inflation and recession fears. Farfetch also missed revenue estimates in what analysts called a very disappointing earnings report. The brand also took a hit from retailers cutting back on wholesale orders for the fall and winter seasons due to excess inventories left over from spring and summer. We have seen a less buoyant luxury customer in the United States and in mainland China. The reality is that the recovery has not been as robust as we had expected when we reported our Q1 results, CEO Jose Neves said during a recent earnings call. Shares of the company were trading at $1.78 yesterday and are set to open at their lowest since the stock market's debut in 2018. Analysts at JP Morgan and KeyBank downgraded their ratings on the stock. At least 6 brokerages have cut their price targets on Farfetch and put the company on the bankruptcy watch list. 11. Showfields. Unique department store Showfields, which described itself as the most interesting store in the world, filed for bankruptcy last week, citing financial problems that began during the pandemic. The retailer was plagued with lower than expected revenue streams due to low sales volumes during the national lockdown and gradual reopening of public spaces across the country, the company said in the bankruptcy filing. Although retail stores began to recover following the onset of COVID-19, Showfields did not see a corresponding increase in revenue at its stores, the company's CEO Tal Zivi Nathanathal revealed. As such, Showfields was increasingly unable to satisfy its additional debt service obligations to its suppliers in a timely manner, Nathanathal said. Now its locations in Washington, Los Angeles, Miami, Manhattan, and Brooklyn are set to be permanently closed in November. 12. Instant Brands. Instant Brands, the maker of the viral Instant Pot owner of brands like Corelle and Pyrex, has just filed for bankruptcy as parent company Cornell Capital pointed to profitability concerns. During the pandemic, stay-at-home mandates made many families turn to their kitchens for entertainment and comfort, and the Instant Pot, a modern take on a pressure cooker, rapidly became a sensation. But just because something becomes a hit doesn't mean the underlying company will have a long-term success. That's particularly true for brands that sell one-time purchase items. Even though at the time seemingly everyone wanted to buy one after the surge in demand was done, Instant Brands lost its core revenue source. During the last holiday season, the kitchen gadget retailer's products helped to drive sales higher for big box stores like Target and Walmart. The problem was that once you owned their products, you weren't likely to need another for at least a few years. In essence, it was an unsustainable business model, which ultimately led the brand to go bankrupt. 13. Soft Surroundings. Women's apparel retailer Soft Surroundings is another brand that just went out of business and is now closing up shop for good. The retailer also sold home decor products, but since mid-2022, consumer demand started to slump. A few months ago, the company announced multiple layoffs in an attempt to save on costs to pay off its debts. But that wasn't likely to save the brand, considering the size of its debt. According to the bankruptcy filing, Soft Surrounding Holdings listed its estimated assets up to $50,000 and estimated liabilities between $50 million and $100 million. Right now, Soft Surroundings is looking for a buyer for its several brick-and-mortar stores and a lender to restructure its online operations. But given the remarkable financial imbalance the retailer was experiencing, it was very surprising that it didn't face bankruptcy sooner. 14. Mitchell Gold. Furniture maker Mitchell Gold Company, which sells under the Mitchell Gold and Bob Williams brand, shut down suddenly late last month and just revealed that it's filed for bankruptcy. Now, thousands of products, many already paid for by retail customers, are stuck at its own and third-party distribution facilities awaiting delivery as the company ran out of cash to fund its operations. A Monday filing exposed that Ryder Last Mile is holding over 2,000 Mitchell Gold products in its warehouses. The goods are awaiting distribution to 600 end customers as the third-party logistics provider waits for payment on delivery and storage charges. Similarly, Furniture USA Distribution, another logistics provider, revealed that it's holding over 1,300 of the bankrupt company's products. Overall, Mitchell Gold Co. estimates it has $6.5 million worth of merchandise stranded at third-party facilities awaiting delivery and another $17 million at its own facilities. That means trouble for hundreds of retail stores that were expecting to receive the goods to sell during the holidays. The company's downfall may also contribute to a temporary furniture shortage during the winter months. 15 AKA brands. Operating apparel brands like Culture Kings, Princess Polly, Petal and Pop, and Reb Dolls, AKA brands first landed on Retail Dive's bankruptcy watch list in March, when analysts pointed to a 50% chance of bankruptcy at the time. From that point on, things have only gotten worse for the apparel retailer, which received a notice from the New York Stock Exchange in the second quarter, notifying the company that it was not in compliance with the requirement that its common stock be at a closing price of at least $1 over a 30-day trading period. Back then, the company's stock was trading at about 40 cents. Moreover, the San Francisco-based company reported that quarterly sales dropped 18% to $149.1 million, resulting in a net loss of $173.9 million compared to a year ago levels, or a drop of $1.35 per share. Even though it has been trading higher on the stock market this month, Retail Dive still believes there's a huge chance the company will run out of money and AKA Brands will have to liquidate its assets in the months ahead. The retail apocalypse is still wreaking havoc all across America, and even established brands are in danger of going under due to rapidly shifting economic fundamentals. This is the beginning of the end for struggling chains, which means we may have to say goodbye to many more stores before we enter 2024. Thank you for watching.